welcome everyone. My name is Chris Bates, CFA Society South Florida Vice President. Thank you very much for joining us for our first webinar of the fiscal year 2022. This evening's discussion, Fueling Growth via the SPAC vehicle in 2021, will run for approximately 60 minutes or so, with plenty of time devoted to Q&A. Directly following this webinar, you'll receive a 30-second survey asking for your feedback, which is very important to us. As a reminder, once we get started, please be sure to use the Q&A feature to submit any questions that you may have for our speakers. We have an exciting year of professional development topics and networking opportunities plans for members and guests. I want to highlight just a few of them. Next week, on Tuesday, September 21st at 2 p.m., we're hosting another virtual event titled Cybersecurity, Operational and Legal Issues and How to Mitigate Them, with two guest speakers. First, Doran Goldstein, leading privacy and cybersecurity attorney of Withers Worldwide, along with our very own board member, Cameron Fatui, who is managing director of Capital Forensics. Please join us to learn how to assess and mitigate critical cybersecurity weaknesses in today's ultra-connected world. And then following the week after that, we will be hosting two separate happy hour wine tasting events, one in Palm Beach, the other in Fort Lauderdale on the 29th and 30th. And then finally, while we have a lot of exciting events coming up for the balance of the year in October, there's one that I wanted to bring to everyone's attention, specifically our 20th annual Alternatives Investment Dinner that will be in Boca Raton, featuring Mark Yusko. He is the founder, CEO, and Chief Investment Officer of Morgan Creek Capital Management. This event will be held on Wednesday, October 20th, and attendance is limited, so we encourage you to register early if you'd like to attend. And now, without further ado, I'm delighted to introduce today's two speakers. First, we have Jeff Ransdell. He's a founding partner and the managing director of Fuel Venture Capital and CEO of Makia Capital Acquisition Corp., a SPAC listed on NASDAQ in 2021. Founded in 2017 and headquartered in Miami, Florida, Fuel VC boasts a portfolio of 31 technology startups based across the globe, including TaxFile, Soundtrack, Your Brand, and Curve. With headquarters in Miami and Latin America, Makia Capital Acquisition Corp. is a $175 million special purpose acquisition corporation targeting tech-focused middle market and emerging growth businesses in North America. Prior to co-founding Fuel VC and Makia Capital Acquisition Corp., Jeff served as a managing director and market executive of Bank of America Merrill Lynch, where he oversaw more than 130 billion global private client investment assets, a P&L of 2 billion, and over 2,000 employees across the Southeast Wealth Management Division. Jeff is a frequent guest on CNBC, Yahoo Finance, TD Ameritrade, and Benzinga. Next, we have Maggie Vogue. She's a finance expert with more than a decade's experience in the public markets, analyzing and managing investments across a wide spectrum of asset classes, both traditional and alternative. Maggie spearheads due diligence processes that determine prospective investments and capital deployment and steers valuation analysis of existing portfolio companies such as Soundtrack Your Brand, Curve, TradeShift, TaxFile, and more. As managing general partner and chief investment officer of Fuel Venture Capital, she was recently appointed to the board of directors of the CFA Society of South Florida. She holds a BS in financial economics and mathematics from Center College. Maggie also sits on the boards of various middle to late stage portfolio companies. And if that were not enough, there's more. Maggie's experience in the public markets and the world of venture capital brings a unique perspective as Chief Information Officer of Makia Capital Acquisition Corporation, a $175 million special purpose acquisition corporation with headquarters in Miami and Mexico. As mentioned previously, the company is a tech-focused middle market and emerging growth business in North America. And we're very excited to learn about, from Jeff and Maggie, the whole process of bringing this back to life. And so with that, for opening remarks, I will hand it over to Maggie.
Maggie, you're on mute.
Thank you, Chris, and I'm very honored to be here today. I got my CFA, I think back in 2013, and has been with the CFA South Florida Society since then. But this year, I took a step further to join the board as a public awareness. You know, really excited to be more involved and contribute to, you know, the group that I have always been proud of. You can talk to my partner, Jeff Ransdell. Any, you know, event or any meeting I participate, I always, you know, talk about the CFA designation, which is, I think, is the most respected designation in the financial industry. So today I'm here to, you know, to discuss about SPAC and, you know, explain a little bit about our thesis and our competitive advantage. I will start with the picture of the day. We rang the bell at the Nasdaq for Makia. It was a very exciting moment, I have to say. Right now, the stock is trading on Nasdaq under the ticker MAQC. And, you know, the reason I want to show the picture, because I just, you know, want to show that we don't just talk about SPAC in theory. We actually go out there and raise our own SPAC. Like the term I always say that we drink the Kool-Aid, because we believe in SPAC as a, you know, a way for a lot of exciting tech growth company to join the public market, to allow the retail investor to participate, you know, a little bit earlier, which we will go further into that thesis in a moment. So let's start out with what is a SPAC? So SPAC are shell companies, or we normally often say that it's a blank check company with no asset or operation at all. And this was created by, you know, a group of sponsors who have a background in M&A, private equity, or maybe successful entrepreneurs. And what SPAC sponsors try to do is they seek to raise capital through an IPO. And with the only purpose is to acquire a target operating company and take it public within a preset period, normally around 18 to 24 months. So at the IPO, the SPAC will issue investor unit priced at $10 per unit. And each unit is composed of a shares and a whole or fractional warrant, depending on the terms that you want to structure. The warrant give investor the right, but not the obligation to buy shares in the future. And normally the strike price is about $11.50. So the capital after being raised, you know, in the IPO will be placed in a trust account and only be released after the SPAC complete a business combination, or in the more like bearish scenario will be returned to the investor if the SPACs fail to do so. So obviously after the IPO, the SPAC sponsor have about 18 to 12 to 18 months after the IPO to identify, evaluate the target, complete the merger. Sometimes you often hear the term called de-SPAC process. IPO investor also play a very important role here, since they can vote to approve the deal. And or when I say and or, I mean that they can approve the deal, but they can redeem their capital also if they don't find the target fit with their investment objective. And the reason why they vote to approve, but they still redeem, is because they still have the warrant, which is very valuable, right? If they reject the deal, the warrant, worthless. So even they don't believe in the target company, normally you still see that they vote to approve the deal, but they keep the warrant. Normally we say that in case in the future the company actually doing okay, they have the upside. And also during this, the SPAC, the IPO process, you hear the term, which I want to throw out here, is a PIPE, means that a private offering of public equity. The reason that we have PIPE in here is a lot of time you see that SPAC will raise a PIPE to increase the amount of capital to fund the bigger deals. If the money in the, raised through the SPAC process, the IPO process was not enough. So that and also to make sure that at the end of the day, after all of the redemption, the SPAC has, enough the minimum cash requirement for the companies. So the simple way I always tell people to understand the difference between the SPAC IPO and the traditional IPO, which I have like summarized into one sentence at the end of the slide, is a traditional IPO Is the company looking for money, while a SPAC is the money looking for a company. Going to this next slide. This is just to walk you through, the three phases that people, from the beginning to the point that they find a target and merge with the target. So normally there's the three main phases. First is the IPO phase, which take about, 8 weeks or more. And during that, this phase, normally the SPAC sponsor group, which we went through it. We had to elect the team member, the board of directors, and develop the investment strategy, like the thesis, what kind of company we want to look at. And then also we have to engage the third-party partners, including underwriters, auditors, legal counsels. And after that, they have to file the S1, obviously, because this is the IPO, which is much easier than filing an S1 for an established company, but you still have to do so. And then you prepare for a roadshow, because our team Makia, we have to prepare for a roadshow, the presentation, and we sit in front of the institutional investor to raise the IPO, the money. And after the IPO, that's when you go into the second phase. That's where we actually in right now with Makia. We search for a target. And this second phase can be as short as 5 months, or can be as long as 19 months, depending on the SPAC sponsor, they going through the pipeline, or any companies that they have in the pipeline. And as a public company, just keep in mind that the SPAC still had to continue to maintain financial, tax filing, and SEC filing, just like any public company. After identifying the target and reaching the acquisition agreement, like I mentioned earlier, this is the stage that the SPAC usually consider raising a PIPE during this stage to help close the acquisition. So in addition to the additional capital that the PIPE provide, it's important nowadays to have the PIPE, because the PIPE normally bring along a lot of long-term and well-known investor, and that's add the credibility to the transaction and also verify the valuation of the companies. And after the PIPE is funded, the deal is publicly announced. You go into, the third stage, and we call it more like a de-SPAC process. And in this stage, the investor needs to vote to approve the transaction for it to close. If the investor rejects the deal, means that if the sponsors still have time, they have to start the searching process again. And I mentioned earlier, the vote normally always pass. And if the shareholder don't like the target, they can redeem the money and keep the warrant for upside potential. But once the deal is approved, the SPAC convert into, and trade under the symbol of the acquired business, just like any other IPO. So going to, going to the next slide, I just think it's very important to discuss the advantage of a SPAC versus an IPO for different players in the market. First, I go into the target company. They like the SPAC route because of three main things. There's a lot of benefit, but I think the three main reasons that they choose SPAC route to go into the public market is because it's certainty, it's speed to market, and it's flexibility. So from a private company standpoint, traditional IPO, can be very tricky and costly, especially if you try to do it during the time that the market condition is unstable, because the price of the stock, let's just say your company, might suffer simply because that the market was down the day that the company goes public. And also on the other hand, if the underwriter is too conservative and they price the offering too low, the companies risk leaving the money on the table. And SPAC help to solve this issue by locking in a price with the SPAC sponsor. And a traditional IPO, from the process, they can start from start to finish, can take more than a year. When with a SPAC transaction from, company identification to completion, you can go 5 to 6 months. And because the SPAC transaction function more like an acquisition, more so, like an IPO, because the IPO is already done. And another thing is the private company now only negotiate with only one party, that is the SPAC sponsor, rather than a host of investors on a roadshow like a traditional IPO. So as a result, the company, can sell more of the business, can attach earn-out, reduce insider lockup, which give the private company more flexibility to tailor a transition to the public market around its needs. And the most important thing which we know about SPAC is because it's a merger, you would do the merger proxy instead of filing an S1. Remember, the IPO is already done, which we did it. So there's the SPAC allow the company to include projection, or we often say it's a forward guidance, which allow a lot of young company or an early stage company, we normally say, to tell the story better, to paint a future picture easier, because you can include the forward numbers. Going to the investor, on this slide, I break it down into 3 groups of investor, because I do think that the benefit depending on the type of investor. So the first group obviously is the SPAC IPO investor, who are the group of putting money in the IPO. So if you remember, I mentioned that they receive shares and also free warrant that offer the potential upside, and also because the fact that they can redeem their shares before the merger and take all of the money back, plus the interest accrued during the time that the money was in the trust, technically they have very limited downside. So you can see that the risk profile return here for the SPAC IPO investor, very attractive, potential upside with limited downside. Going to the PIPE investor, normally they are institutional investor, long-term investor, and they are offered to have a look at the target company and invest in a PIPE. So I talked to some of them, and the most benefit I heard they normally mention is they think that they have more time to conduct extensive due diligence on the target, because normally during the traditional IPO they have very short amount of time, and then also in the PIPE they get a larger allocation. And sometimes, because the PIPE is very important to verify the transaction, a lot of PIPE investors even have the right to negotiate to make their deals more attractive. Which, when if you're familiar with the traditional IPO, normally if they depending on how important they are, they get a smaller allocation and they don't get to negotiate at all. It's just whatever the price, they have to take it. And then the last group is the retail investor, which Jeff will mention a little bit later about the trend of the company staying in the private longer and the impact of it. But to summarize it and to highlight the benefit for the retail investor is basically the trend of staying in private has limited the flow of new companies into the public market, because they can raise a lot of money in the private market. So they don't come when they still young and have a lot of runway, but that really limits the ability for the retail investor to have exposure to emerging industry, exposure to young and exponential growth company. So with SPAC, what SPAC does is SPAC taking the private company to the public company when they still young, when they still have a lot of growth runway, and benefit the retail investor more so than just the investor in the private market. And the last group here, obviously the sponsor is the one putting everything together, and they are attracted to the SPAC for the economic incentive and the ease of raising a SPAC. I mean, I'm in the VC business, and I have to tell you that I think raising a SPAC is much easier than raising a VC fund, just because the structure you offer the IPO investor, the upside and limited downside, is make it much easier to raise a SPAC IPO. And that's explained why a lot of people, try to be a SPAC sponsor, including the people who actually have experience and knowledge and the people who don't have anything at all. So this, to describe the benefit of the sponsor, they basically receive a special class of shares, and that share allow them to have an outright position in the target company later after they merge, and that allow them to earn or the additional upside in the post-business combination entity. And further than that, right, many of the sponsor will play a significant role in the company going forward. They either be, holding a board's position or maybe even an executive chairmanship. And if they do very well and successful, they can continue to have, more SPAC transaction. So as you can see here, that this slide summarized, all of the benefits for different groups in the SPAC space. So let's go to the next slide. I think that, I'm sitting here talking about what is SPAC and, what is the process of SPAC. And, we have to be wondering that why we are doing it. And obviously there's a reason behind it, that SPAC are not new, but we never really heard about it until recently. They normally, they actually been around for like 3 decades already, and they have cycled in and out of favor with investor, but have become very popular in recent years. And I have 2 charts here. I think that it will show you, kind of like paint the picture very clear. So if you look at the one on the left-hand side, that's just showing the SPAC IPO or the money raised in the SPAC IPO for the past, say 12 years. And in 2020, that's when you can see that there's an exponential growth. So more than 83 billion was raised across 248 SPACs, and that compared to 13.6 billion raised through 59 deals in 2019. That is more than a 6x increase in terms of dollars and 4x increase in the number of deals. And then going into 2021, the Q1, we talk about Q1 only, and there's a reason behind that, because Q2, the SPAC market really cooled down, but the Q1 only already broke the record of 2020 with close to 100 billion raised through 300 SPACs. And to give a perspective of how big the SPAC market has become, you move to the chart on the right to look at the market shares. So before 2020, SPAC never outperformed traditional IPO. And capital raised by SPAC never make up more than 20% of the total IPO proceeds. But in 2020, the 248 SPAC IPO raised in 2020 account for 55% of the total IPO and 46% of the total IPO proceeds. And as of right now, despite the slowdown in the SPAC market starting in Q2 2021, the SPAC IPO market share is still very high compared to the traditional IPO. So these records on this slide demonstrate that SPAC has entered the mainstream, bridging the gap between the private market and the public market. Going to slide 8, obviously, as a CFA, we always very curious about, okay, if something going, exponentially going through an exuberant stage, we want to understand what is the reason behind. So I think there's a couple of reasons behind driving this SPAC boom. Actually, Chad, if you don't mind, can you go back to the slide? Because I want to, one slide, I want to show, if you look at the chart on the right-hand side, the last time SPAC IPO activity peaked was during the global financial crisis, right? And then this time is, during the pandemic time. So that showing that the macro factor have contributed to the SPAC surge in 2020 for sure, because as the global economy has continued to work through the economic impacts of the COVID-19 pandemic, the uncertainty and also the warning of, the dry up of funding environment have encouraged many founders that we spoke with. They want to choose SPAC as the vehicle of choice to raise capital while shielding their company from the market volatility because of the, locking in the price I mentioned earlier. And obviously the type of companies that went public via SPAC today, like Virgin Atlantic, DraftKings has raised the attention to SPAC. Can you go to the next one? So that was the first one, the macro factor. The second driver of the SPAC boom, I believe that is the improvement in the SPAC structure, which make the sponsor and the investor more aligned and remove a lot of stigma attached to the SPAC in the past. And more importantly, going to the third one is the SPAC growing association with high caliber institution and people really led to a rebranding of these financial vehicles. So if you're looking at the right-hand side, I list all of the names of, different institutions, different people, different organizations joining, this SPAC space. And why is this important? I mean, if you think about it, right, the investor putting money in a SPAC IPO without even knowing what company that they invest into. So technically they investing into the SPAC sponsor. So, the better the reputation and the track record of the SPAC sponsor, the more confident the investor have in the SPAC offerings, because they know that these sponsor will have the ability to find the deal, to execute on the deal, and to create value to them. And you have a lot of name here from the bank standpoint. You have Goldman Sachs, you have Morgan Stanley, and even Stifel, which is the organization very close to us. And we work with them very closely, having them involved, helping us with both the VC business and the SPAC business. And from the SPAC sponsor, you have Bill Ackman from Pershing is involved. And in fact, I was very lucky, right? This morning, I was in a conversation with Chin Chu. He's a Vietnamese billionaire, and he built his career in private equity and now he created his own company, CC Capital, and he already launched his 5th SPAC, which is amazing. And he still have 2 SPAC out there. One is 600 million and one is $1 billion during a very tough time. So it was very encouraging talking to him, hearing his insight about the SPAC market. And then the last one, I think the main reason that the SPAC market has attract a lot of people just because, at the end of the day, I mentioned earlier, right? SPACs offer a unique and wide area of benefit to different players involved. And when everybody involved is very, beneficial, like, make money or from the SPAC, they really push the SPAC into the spotlight and more people involved. It's more like a network effect. It's allowed to attract more private companies, more sponsor and more investors to join the game. So that's just unleash on financial products that has otherwise been very much, in the background and kind of like you hear SPAC everywhere today. So I think those are the key driver of the SPAC booms over the past, I would say, 18 months. Let's go to the next slide. And I think this slide, I'm going to turn it to Jeff Ransdell. He's the CEO of Makia Acquisition Corp. And he will tell you a little bit about, our thesis, our competitive advantage, and, why we decide to, raise our own SPAC.
Well, good afternoon, everyone, and thank you for dialing in for this talk. It's an opportunity which my partner Maggie was very excited about. So Maggie kind of really, I think, went over a lot of the macro theories of the SPAC market and what's really happening. And really what I want to try to do is break it a little bit more granular into the micro thought process we put into it. As Chris mentioned in the beginning of this segment, I spent 21 years of my career on Wall Street at the top of the house of one of the largest financial institutions on the planet, which gave me a tremendous amount of insight into a lot of different things. In 1994, when I started my career, I'll tell a little story and then we'll try to reverse it back and bridge back into the slide. But in 1994, when I started my career, there was a little company called Amazon. And from 1994 to about 1999, I would say that Amazon was one of the biggest jokes on a daily basis on the trading desk in New York City. What in the world is this Jeff Bezos guy thinking, well, he's going to sell books online? And back in 1994, 1995, 1996, online really wasn't what it is today, obviously. But what's really interesting to me in my 28-year career and what has happened to the public markets is it has shrunken. And you are all CFAs, you know what I'm talking about here. In 1994, when Amazon went public, and we're going to show you some numbers here, but when it went public, let me move this. It had top line revenue of $31 million. Its valuation or market cap when it went public in 1990, I'm sorry, I said 94, but it was 97, was $438 million. And what's important about that is you go from 1997 to today, and your market cap for Amazon is around $6.5–7 trillion, depending on where the stock is trading on any given day. And what that is telling you is that multi-generational wealth has been created in the public market from a company like Amazon. But if you fast forward to 2019, and you'll see on the slide on the right, we use probably the biggest marquee IPO in the last couple of years was Uber. It was the most expected, and sought after IPO on the street. Difference between 1997 and 2001, however, was that Uber had been in the private markets for 10 years, where Uber or Amazon had been public or private for 3 years. So Uber had been private for 10 years. It had top line revenue, of over $10 billion, and it had a market cap of 78 million or 78 billion when it went public. Now today, I haven't had a chance to look at the markets today, but my guess is still to this day, all of the wealth, 100% of wealth that was created in the private sector. And as of today, there is not any wealth that has been created in the public sector. And this is a really important notion. And it really starts to get into the sponsors of these particular SPACs. Maggie was talking about the boom, and you can kind of see in 2020 where it really took off. And one thing that he didn't mention, which again is the personal thesis of ours, but if you think about all of the capital that has been pouring into the private sector, you start to understand, what is the bridge that separates public and private? The private market is constantly looking for great private companies that they can bring into the public markets and offer it up to the investing public. On the private sector, however, Maggie and I can spend 4 or 5 years identifying great companies, great technologies, curating these companies, getting them ready, for a potential exit. But at the end of the day, if another major corporation doesn't come in and buy one of our companies, or we can't take that company into the public sector, it is impossible for us to monetize time, energy, and mental capacity and capital. So what is happening in the marketplace right now is you have a tremendous amount of capital that's gone into the private sector, and that capital is looking for its exits. And that's one of the reasons why you're seeing such a burst of activity in the SPAC market. The efficiency to get into the public market, the bumpers and barriers that are traditionally established for a traditional IPO aren't there for the SPAC. And that's why you're seeing this. And the other item which I'm trying to highlight, and what our sponsor team is really trying to drive from an artistic perspective, or our thesis in the marketplace, is we are not interested in identifying companies that already have valuations of $1 billion or more, which has been the theme for many years now. And we're going to show you in just a couple of seconds what that has meant for the investing public. What we're interested in is trying to find the Uber of 1997, or the Amazon of 1997, not the Uber of 2019. We're trying to identify companies that have tremendous amount of what we would refer to as exponential growth left in them, bring those companies to the public markets so that the public investor has the ability to participate in that multi-generational growth. The fact of the matter is, in the private sector, if you don't know somebody who knows somebody who knows somebody who knows us, you can't actually get access to a lot of the companies that we look at on a daily basis or are already in our stable. And that is one of the things we're trying to do, and one of the reasons why we decided to become a SPAC sponsor. So what you see in front of you here is that stable that I was just referring to. The Fuel Venture Capital is something that Maggie and I actually spent 3 years on before we deployed $1 single or actually raised $1 single for our private equity firm. Was we really got on our horses and rode out into the future 3 and 4 years and asked ourselves what were going to be the verticals that technology would play the biggest role of disruption. Then we came back into the present. This is a 2017 vintage. So Maggie and I and our team have spent the last 4 years really scouring the earth, looking for amazing founders, incredible technology, and companies that we felt could backfill the 8 verticals. And the reason that I'm bringing this up is, again, if you're thinking about that bridge between private and public, and we're going to show you in just a second the results, but you have 2 types of SPAC sponsors. You have a SPAC sponsor who is an investor. They're maybe a very good investor. And you have a SPAC sponsor that it's an investor and has operated companies in the past. And when you look at the performance of the 2, they are very different. Your operating sponsors tend to outperform your strict myopic, just placing a portfolio manager at the helm of a public company that is going to merge and create a de-SPAC in the marketplace. The reason why we're sharing this with you is because, again, the biggest challenge for a SPAC sponsor is to find a great company that would be attractive to the investing public. There's not a day that goes by that we're not getting a phone call or someone knocking on our door downstairs wanting to grab access to this group of companies in this slide. On this particular slide, you have 3 unicorns, meaning you have 3 companies that are already valued over $1 billion, and you have 5 unicorns, which means that it's 1 round from being a unicorn. So it's a very, very, stacked up portfolio. SPAC sponsors want access to it. The problem, and I think the highlight that I would bring to you is those individuals who are knocking on our door or trying to gain access to these portfolio companies actually have very little history with them. They don't know a lot about them. Yes, they can go do their due diligence, but there's a big difference between understanding financial statements and models and actually working with companies for many years, developing those leaders, and having a tremendous amount of influence. I mean, there are some of these companies where Maggie and I were the very first investment that ever went into them. And those particular, founders, CEOs, and operators, I mean, I like to say this, but it is a joke, but there's never a 100% joke. Most of the founders that you see on this page won't even, go buy a ream of paper without asking us if it makes sense or if that's the supplier that they should be using. And I brought it up only because of the influence. And I think it makes a big difference in how we are approaching the space versus the others. So some of the things that we look at when we are looking for a particular SPAC, on the top side, you have your private market analysis. This is the stuff that we do in the private sector. Maggie and our team typically look at about 5,000 companies on a yearly basis. It sounds like a lot, and it is. But in this particular space, you have to look at a lot of companies. We have a very disciplined filter system that we go through. And because of that, we do have to look at a lot of different companies on the supply side. So at the very top, you'll see the market opportunities and competitive landscape. You're all CFAs. These are nothing that is going to jump out at you at being oddities. Your business fundamentals, which obviously need to be there. And I think it's one of the things that if we said the negative headwinds in the SPAC areas, you have some SPAC sponsors that are bringing companies to the marketplace or to the public markets that don't even have revenue, et cetera. Our particular, thesis with respect to that is, that's a no-no. And we're going to, again, get into that in just a few minutes. The growth momentum, as I just got done saying, to us is a must. Without the ability to provide what we would call, significant growth opportunities for the investor, it wouldn't be something that we'd be interested in. We're looking for multiples, not percentages. On the bottom side of this, and the public market analysis, there's a lot of things that on this top line, the public market readiness. One of the things that Maggie and I do on the private side is when we have a company that's getting to that unicorn or unicorn level, is we're starting to train and develop the leadership team to be prepared for what it's going to be like when they become a public company. And we all know that that's a very different world from private to public. And we've seen a lot of disasters in that world. I can, Uber, again, if we use that as an example, is a great example, right? The founder of Uber, incredible vision, got that company going, but at the end of the day, it wasn't the right leader to take it into the public markets. And one of the things that Maggie and I spend a lot of time on is making sure that our leadership teams are ready for that role. Obviously, it can play a big difference on its success or its failure. The public market fit, again, nothing new for all of you, but the one thing that I will say, which is again is a thesis of ours, is what we refer to as the wow factor. And what I mean by that is, I think in today's world, when information flows so freely and the world is really very flat, if you're going to take a company public, the first thing that most investors are going to do is they're going to get onto their laptop or their iPhone, and they're going to Google the name of that company. They're going to Google the CEO of that company. And what we believe is if you go to that Google search and there's not pages and pages of information and pages of of exciting news about that founder and that company and what they're doing, and a lot of people that are saying wonderful things about it, it will be difficult for that company to be attractive in the public markets. It will be a difficult for algorithms to pick up that company and add them to the hedge fund that algorithm is aligned to, et cetera. So it's one of the things that we actually look at. It is a new element, a new filter that maybe, you know, it's not going to be taught in a CFA program, but it is definitely something that we believe is very real in today's world. And it's something we spend a lot of time trying to understand. The deal analysis and the valuation with Maggie CFA, I would say it really gives us an edge. She, I believe, has an incredible private equity valuation thesis. We have a lot of public major financial institutions that lean into us for our private valuation thought process, from Stifel to Goldman Sachs to JP Morgan, et cetera. And again, that's just, I think, to give Maggie where the credit is due, and one of the things that I think gives us an edge. What this slide is doing, and I think I need to move pretty quickly here, as I said to Chris in the very beginning, I'm not worried about us not having enough time. So what you see in front of you here is again, our belief, you know, what we believe is it's time, it's energy, it's mental capacity, and it's capital. What this slide is all the things that our firm does outside of just the capital that we invest in a company. So typically these are companies that are going to be needing to acquire talent to prepare themselves to be in the public markets. So we have in-house a complete talent recruiting team that does nothing but global searches for our portfolio companies, or our target companies, I should say, that we're getting ready to take into the public markets. That's in-house, and we can get that done, you know, simply by going down the hallway and speaking to our team in that particular station. We have literally 4 different tech teams. We have a very strong tech team in Asia. We have a strong tech team in Russia. We have a strong tech team in Latin America, and we have a strong tech team here in the United States. And we use those different tech teams depending on the underlying technology that we're looking at, and oftentimes what the need is with respect to that tech. Technology is something in today's day and age that is evolving. There's constant iteration and constant change. And so we believe it's a very, very important station to have. I already talked a little bit about this. Station marketing would go into your wow factor. We have a team of 10 people that are here on a daily basis, and their job is to do one thing and one thing only, and that is to make sure that the portfolio companies that we are involved with are getting known and trusted on a daily basis on a global footprint. If you were to Google any of our companies or Google us, Fuel Venture Capital, you will see a lot of stuff that is going on that is not by accident, and it is very strategic. And then you can just kind of go up through to the top and see the different things that we are focused on in helping our portfolio companies ultimately make it into the public markets with our SPAC or another SPAC. This is, I think, just the reality of what's going on. As Maggie indicated earlier, we saw a big spike in 2020 with respect to SPACs. I've already spoken a little bit about why I believe that is present. Maggie has already done so as well. And then you see here the Q1 21, there was a big drop off between Q1 and Q2. And the reason for that, and for all of you who have been around, you know, I'm going to age myself here a little bit, but as I said earlier, I've been in the industry now for 28 years. And for those of you who are on the line, who have been around for as long as I have, you will know that the financial markets have a tendency, when something exciting comes out, there, you know, the herd will follow the rest, right? The herd mentality, if you will. And what always happens is that the SEC will start to take a look at that big jump up from Q4 of 20 to Q1 of 21, and they'll start to say, okay, and I mean no disrespect here, and I hope I don't offend anybody, but you know, Shaquille O'Neal, I think, is one of the greatest basketball players that has ever existed, but I'm not sure that he is one of those individuals who should be really the sponsor of a SPAC. You know, I'm not completely sure that if I'm the SEC or a governing body would say, that's one of the people that we want investors to be following into the public markets and identifying companies to take into the public markets. And so what ends up happening is the SEC starts to tighten things. We've all seen that, and it makes it more difficult for some of the players that are currently on the field to continue. And we start to see, those individuals who, in my humble opinion, probably should never have been in there in the first place, and they fall off the field. And that's what's happening now. Now, to us, we were hoping for this. I'm an expert witness for the SEC. I'm an expert witness for FINRA. I have a lot of friends in those two particular things. And I would say that what we find is that, we want things to be more difficult, because that means that these operating sponsors who understand this business, understand the public markets, understand the private markets, understand that we're here ultimately at the end of the day to serve investors. And if you have those things in mind, you deserve to be on the table, and you deserve to continue to have success in the marketplace. And that's what we see is going to be happening here. We do not believe the SPACs are going to go away. We think that the volume of them will drop, and they should, but the quality of the sponsors that will be left on the field will be the sponsors that will be here, over the long run, and what I would call, people that are in the business for the long tail, which is the right reason. And then Maggie, why don't you jump in with me on this one? I'll let you take the left-hand side. I'll take the right-hand side. You're on mute, Maggie. There you go.
Yes, so this chart, just to give you an idea about how, the SPAC, we said a SPAC company has been performing versus the market. So on the left-hand side, you have the chart graphing, the two index, the S&P 500 index and the Nasdaq. And then, the Renaissance IPO index is just basically company go through a traditional IPO, and then the SPAC is going through the IPO index. And, to prepare for the webinar today, I just feel like I want to look at how they perform versus each other. So I grabbed this chart and pick a time frame of 18 months going back to April of last year, because I think that's when all of the discussion attention is toward the SPAC market. And as you can see here that, SPAC, the bright blue has been going upwards since April of last year to February of 2021, with, a lot of momentum driving the SPAC IPO. And then with the whole SEC's tightening regulation. Also, there's a couple of things, right? I mean, after going through the whole a little bit craziness stage, I think that a lot of investor was worried that if there's so many SPAC out there, do they have enough target companies, good companies to tag to the public market, or are they just running out of time and the bomb is ticking, so they just pick whatever the companies out there? So that's concerns also, I think, explained for the SPAC capitalize slowing down a little bit. And then also as you know that the interest rate has kind of like creeping up also. That's explained a little bit for the slowdown. But I do think that the main reason here, which make this, the SPAC market has been in the narrow range and haven't really turned around yet, is still the first two factor, which is one is the regulation tightening, and then also is the question about if the SPAC can find the good target to tag to the public market. And then going to the right-hand side, you're looking from the top, obviously, compared to the other two indices, and the traditional IPO, SPAC IPO doesn't look like really outperform. But if you look under the hood a little bit, I think that's very interesting data here, showing that the SPAC, we call it operator-led SPAC, is actually outperform, we call it the investor-led SPAC. And that's really, I think it makes so much sense just because, I'm in the venture capital business. We always tell our founders that we're not a passive investor. We're not just giving you the money and then walk away and then let you do whatever with the money. It's the same thing with the whole SPAC business. We're not just, go and raise a lot of money through the IPO and then just hand it off to the founders. Some of the founders don't even have experience running a public companies. So I think that if you have, some operation experience like Jeff has over his career, it's really helpful and it's really adding a lot of value to the companies. And that ties back to, one of the criteria we look at when we go through the list of the target, right? We're looking for the opportunity to add values. So that just means that you add value from different way for short term and for long term. And the short term maybe, cutting costs, remove some of the manager, so that you can drive the performance for the company. And, ultimately you can see that on the, the stock price. And then for the long term, right? A lot of institutional investor investing in our target company, our SPAC, because they want to stay in the long term. So you want to see that there's an opportunity to create value for the long term also. So I just think that, as a CFA, we always like to look under the hood. We don't want just to look at on the surface. I just want to share the data here so that, just want to share with you guys.
Well, and I
That's
think,
great.
and maybe in closing, the slide on the right is what I was trying to articulate, right? That at the end of the day, our belief is that the SPAC market is a very efficient and effective way to handle a lot of the private sector capital that has been raised over the last 10 years or last 20 years, I should say. And at the end of the day, it's no different than any other investment that any of us make. A lot of it has to do with the people that are at the helm. And I think that that's what the slide on the right is saying. If you have, if you're investing in a seasoned sponsor who has a strong thesis, I think it's a much better investment than someone who doesn't. And then to add to that, of that seasoned investor, what do they actually have the ability to lean into? What do they have a tremendous amount of private client or private investment, garden that they can go into and pick from? I think that is another very important investment thesis that people need to be thinking about. At the end of the day, it does matter who's at the helm, and it does matter what those individuals have access to. So with that, Chris, we'll turn it back over to you. Those are our prepared comments.
That's great. So now we're ready to turn to the Q&A portion of this event. As a reminder, if you'd like to ask a question, use the prompt, the little icon at the bottom of the screen, and you can submit your question electronically. We do have a number of questions in the queue. I'm going to start with, really, it's more of an administrative question, but we've had several people ask, is it possible for you to share the presentation slides with the group, if electronically, if they're interested?
Yeah, I think it will be fine. Okay,
that's great. So maybe we can just send it to the attendees. We have their email addresses. Does that work?
Jeff, but
Yeah, I think
we'll be fine, but given the fact, I have to let me pause a second, Chris, because I think it'll be fine because this is the material I put together. But given the fact that it's Maggie Capital Acquisition Corp, Jeff, and it's more like a public company, not like few venture capital material I can share with anyone I want. So do we have to check that, right, Jeff?
Yeah, we'll check with our attorneys, Chris, and I because of the audience that we're speaking to now, I don't think that it'll be a problem, but it would be amiss for us not to make sure that what we're providing you is proper. So we'll come back to you on that. But I don't
think we wanted to be mindful because I noticed at the bottom of your presentation it did say confidential, not for distribution. So I thought I would ask the question. Another administrative question that came in. Yes, this event is being recorded, and you'll be able to find it on YouTube. Actually, if you just search by this particular event. So now turning back to the topic at hand, you did touch on this briefly, Jeff, on slide 12, And we got a couple questions around, it was one, why did we see the pause, in SPAC? And, do you believe ultimately that the use case is there, that, maybe this is a temporary pause? And embedded in that question was, how do you view Gensler at the SEC in particular? In other words, with once we have, you use the example of Shaquille O'Neal, once we have, high profile, celebrity investor based SPACs go by the wayside, do you anticipate that the volume, might pick back up with operator led?
I'll lead with this. I'll turn it over to Maggie afterward. But my personal opinion is that the spike that we saw in Q4 was too much, and it was just too many people that were coming to the table as a sponsor. And again, I think the most amazing thing that we have in the United States is we have an organization in the SEC that is there to protect the investor. And I don't think that the SEC takes a step back and looks at the universe of sponsors when we saw the spike and said to themselves, I would put my money with these people. And when that happens, they have a responsibility to make it more difficult. And again, as I said in my prepared comments, we, at Makia are very happy about that, because we believe, you're all CFAs and you know what I'm talking about here. I mean, you don't call a plumber to fix an electrical problem. And so, we want to see things get cleaned up. I don't think that we'll have the volume that we saw before, but what you're going to have in replace of that, I hope, what I would say is what you're going to get from us is quality. We are not going to bring a company to the public markets that we do not believe aligns with our thesis, which is to provide, the investing public the ability to participate in companies that have significant growth opportunities. I know one of the questions was, what is the sector that we think is going to produce the most returns? The disclaimer to what I'm about to say is you have to understand, I'm a venture capitalist. I invest in technology. I believe that technology is changing the world. And because I am in it on a daily basis, if you saw what I saw on a daily basis, you would understand why I feel the way that I do and why I'm as passionate about it as I am. But if you look at the overreaching markets today, what's driving the markets? It's all technology companies. So, it's our job to find that next, generation of technology companies to fill in where these other companies who maybe didn't iterate as quickly as they should fall to the wayside. So I think it's more quality over quantity.
Okay, appreciate, great answer. In terms of this is more of a structural question. So should a SPAC actually not find a suitable candidate in the time allotted, and they were to return the money back to investors, is there any time value of money fee that they earn, or do they simply just get their principal back?
No, so the money putting in the trust will be invested, but in their short-term treasury. So you get some interest, accrued during the 2 years or the 18 months that the money is in the trust. But a lot of people are talking about opportunity cost because they don't compare with they don't look at the short-term treasury yield is a lot. They're basically saying that you can take the money, you can invest in something, grow much more than that. So that is one of the thing a lot of people don't want to park the money for so long, but you do get more than just your principal.
But I'm going to jump in on that, Chris, because I think it's another insight for everyone that's on the call. Again, I think it from the due diligence perspective, right? Who's at the helm, and what are the things that those individuals that are at the helm are trying to do to differentiate themselves? It's the old purple cow theory, right? How do you differentiate yourself in a field that looks very similar? And one of the things that very confident sponsors will do is they'll say, no, we don't need 24 months. We don't need 18 months. We're going to get this done in 12 months. And so those are things that you can think about before you make a decision that, I'm going to bet on this sponsor team. There are messages that are being sent around confidence and also, what they believe that they already have lined up, for example.
And so, based upon your earlier comments about, the underlying quality of the SPAC operator or who's bringing the SPAC, is there any information necessarily that can be gleaned from a SPAC that's trading below $10?
Before the target has been
Right, before
announced?
they've actually acquired something.
If it's trading below $10 and they haven't actually announced their target, I mean, we have 30 some CFAs on this call. To me, if it's above $10, what that is telling you is that the investing public right now has a high degree of confidence in that leadership team behind that SPAC sponsorship. And if it's not, I don't think it's necessarily a bad thing, because you really haven't announced anything, right? It's just, it's maybe a scoop of chocolate and a scoop of vanilla. But if the company's trading above $10, well, then that's telling you something.
Yeah.
That's definitely a positive indicator.
Great. The next question is, how do you feel about VC firms themselves going public, which is a growing trend in the UK, Europe?
Maggie, you want me to run with that, or?
That's open to anyone.
Yeah. So here's my thing on that. Here's my thing on that. First of all, that's one of my personal attractiveness to SPACs. I said this earlier. If you don't know someone who doesn't know someone who knows someone who doesn't know us, it's really hard to get access to these things. That's one element of scarcity. The other element of scarcity is if you're not accredited, you can't participate in this private investing sector, right? So once it gets to the public, well, that scarcity gets removed and it becomes more abundant. So for a venture capital firm to go public, my humble opinion is it's not the proper move, because again, we tend to have, because we come from the public markets, we have a very large focus on risk mitigation. We're not the type of managers in the private sector that invest $200 million in 25 companies and wake up every morning and pray to God that something works. That's kind of a horseshit way of, pardon my language, but it's a horseshit way of managing other people's money. So, we spend a tremendous amount of time on the risk mitigation and really bring something quality to our investors. And so, but it's still, these are companies that are growing, and there's a lot of things that can go wrong, right? And so I don't think that it's for the masses. I really don't. So, that's my humble opinion. I think that private equity venture capital should stay private equity venture capital. And when there's companies that deserve to go into the public markets, something like a SPAC can do that very efficiently and very effectively. Maggie, I don't know what your thoughts are on that.
Well, I think you answered a lot, but definitely, I mean, I'm glad that we're on the same page, even though this is the first time people asking us taking a VC fund to public, but I'm going to vote for a no. I don't see us as a pure VC doing that, because I really like the fact that, we being a VC, we find a lot of creative way to add value, both from the founder side and from the investor side. And I just don't know if the public market, ready for that, or, or the scrutiny will limit the creativity, which I think one of the reasons I moved from the public market to the private market, because I just really amazed by, the creativity that we see in the private market. That's just my humble opinion.
Okay. And what about someone, another attendee asked, do you feel like SPACs compete against BDCs, or do you view them as sort of separate entities altogether?
What is BDC? Maybe we can come back to that, because I don't know what's BDC stand for, what they mean.
I think it's Business Development Corporation, I believe. But maybe the person who asked the question can further clarify, so I can, if I didn't ask the question in the right way, maybe they can re-enter their question so we can get it addressed for them. But in the meantime,
and Chris, I think you missed another one right on top, asking if do you have to do IPO SPAC to get the warrant? So I can answer that, but the warrant is like a sweetener for the investor who invests in the SPAC IPO. Right? Not like the pipe investor or not the retail investor. You don't get that. You you pay the $10 for the unit. You get, the shares and some of the warrant. It's kind of like, if you think about it, it's kind of like free warrants, but that's just a sweetener for people to coming into, the SPAC IPO. And then later the warrant will trade separately with the shares. So, whoever own the warrant can sell that warrant to anyone they want to.
Said another way, that the warrant is picked up when you are on the institutional investing, when you're raising, when the SPAC sponsors raising the capital that will ultimately be given to the target, the warrants are given to those investors. There's a lot of family offices, by the way, that are starting to get into that space. When Maggie and I raised Makia, there was a number of family offices that very much wanted to be a part of that, and ultimately did. And so for those of you who are on the call that are CFAs working family offices, that it is an incredible investment space, right? Because that warrant is very valuable and you have a tremendous amount of optionality.
okay, I'm going to go ahead and read this one. It's a longer question. It says, when I entered the industry, our focus was on highly limited buy-sell circumstances of greatest interest to private owners. Currently, my concern is that most of the transaction flow is through, in quotes, across the waterfront auctions. In your sourcing, how much do you weigh auction processes versus limited and more principal-to-principal talks?
I actually will need to, verify these terms because I'm not familiar with the term at all. When maybe, in my space, but what is auction process versus limited, more principal-to-principal talk? And unless you know, what does it mean, Jeff?
Well, I think it sounds incredible, but again, I don't want to opine on something that I'm not exactly sure where he's going with that. So I think I would take Maggie's side on that one and choose not to. I mean, I could throw some things out. Yeah, no, I'm not sure what he's.
Don't worry, we'll edit it out.
I did warn Jeff one thing.
I live in Miami, right? And the English language is the second most spoken language in Miami, right? But and now I'm on a CFA call, and the English language is the second most spoken language, I feel.
Well, Chris, I did warn Jeff before we get on this webinar. It's like you speaking with CFA people. They're super smart people. So unless we know something, let's answer it. If we have any doubt about it, let's say that we're going to do research and get back to that. Let's just don't come up with something we're not 100% sure.
Okay, very good. Then then the final question is, and this is rather topical for those who sort of follow the SPAC industry. Any thoughts on Ackman's Pershing Tortines deal, and what, if any, sort of precedent that may have, with this segment of the market?
Sharon, would you like to
get asked that question? Yeah, I get asked that question a lot. First thing I will transparently tell everyone is I'm a big fan of Bill's. I followed him my entire career. I think that he is absolutely brilliant. But you have to understand his mentality and his confidence around everything that he does. And I personally think that particular trade, it was like, it was very, non-traditional. We all know that. And, again, I can't speak for him, but, if I look at it from the outside looking in, I would say, this is a guy that does not lack confidence in any way. And, look, let's see if we can get away with this. And again, if you go back to the one thing that we have in the United States, which is just amazing, is the SEC. And the SEC stepped in and said, well, hold on a minute, Bill, this doesn't work, right? And it didn't happen, right? And so, the question often comes to us, is it going to have an effect? And I don't think it will, because it didn't belong. It's not what SPACs were meant to do. And the SEC knew that. And as a result, it never moved forward. And so I don't believe it'll have an effect at all. But at the same time, I think it's wonderful to watch, and it's a great case study. And if you follow him at all, it shouldn't be a surprise to anybody.
Right. So I did have one question, and it relates to your firms, and that is, are there any hurdles from Rocket Fuel from selling a portfolio company to a Makia SPAC? In other words, you could have the appearance of self-dealing, and I'm just wondering, are there any regulatory guidelines that prevent venture capital from selling one of their portfolio companies into one of their SPACs? In essence, what you're doing is you're creating your own exit event.
Yeah, and it's a fair question, Chris. And we have spent a lot of time on this. And the question is really around perceived conflicts of interest, I believe, is maybe the right way to frame it. And so it's Makia is not just Maggie and myself. We have a number of partners. The voting rights, quite frankly, at the end of the day, Maggie and I can be outvoted. How we look at it is, do we believe that Maggie and I's involvement in Makia is ultimately, at the end of the day, a benefit to the end investor? We believe very much so, for all the reasons that I was sharing, right? You've seen this type of activity over the last 9 or 10 months, where there's a SPAC sponsor that's being sued because there was a skeleton in the closet and they didn't know about it. They took the company public, and it ultimately affected the investor. And I said that earlier. You got a lot of people that are knocking on the door every day. They don't know these companies because they haven't been with these companies, for the last 4 or 5 years. Maggie and I know where every skeleton is, if there is one, and we would never move forward a company that we thought, had issues, because again, at the end of the day, we're ultimately responsible and serve the investor. But to answer your question more concisely, how you deal with potential conflicts of interest is you disclose them, which we do in all of our documents. So at the end of the day, an investor, again, when they're doing their due diligence on who's at the helm, they understand that Maggie and myself might have interest in that company as a private organization that is ultimately being, taken into the public markets. But it is fully disclosed, and investors can decide if that is a positive or a negative. And again, that's the beauty of transparency.
Exactly. Well, this has been fantastic. I want to thank Jeff Ransdell and Maggie Vogue. Maggie's also, again, I want to repeat, is a new board member for us. I really appreciate you both coming and sharing your experience, and we look forward to having you back again. So with
Chris,
that,
thank you for having us.
Thank you, Chris.
thank you all for joining. We hope you found it informative. Take
Well,
care.
a big shout out to James Green, who said it was an excellent seminar. So James, thank you.
That's great. We love the feedback.
Thank
All
you.
right, everyone. Thank you for your
thanks.
time.
Bye-bye.
Take care.